Hello, ladies and gentlemen. I am the Acca tutor, Mr. James Timkulu. I am very happy to be with you once again in our week 8 of the Acca FA1 paper. And we're going to talk more about control accounts in this week's lecture. Okay. Now, in this lesson, we'll discuss the need for control accounts and the principle of internal check. Now, as I've just hinted, these are the topics we will be discussing throughout the lecture: the internal check, control accounts, and the reasons of having them, and then how to do the control accounts reconciliation. So, after we do those things, we call it a day, and we should be ready to write the assignments. All right. As you know from the from history or from your experience with us so far, you know that we are meant for business, and we struggle to ensure that you guys understand what you are studying. Sometimes some people might feel, or some students might feel that it sometimes delay them to finish by causing them to do corrections on failed assignments. This is our policy. If you do not get 50% or more, you're not going to go to the next topic. That one is the rule. We want to ensure that the studies are not taken for granted. Some of you have got money, yes, you just want to pay for the studies, and then you just say you do not care when you want to finish the Acca qualification and so forth. No, we don't work like that. We encourage people, we encourage students to just commit themselves to the studies, and they have to ensure that they do the assignments wholeheartedly and they pass them and move on to the next stage. Okay, without wasting much of your time, let me just go ahead with the business of the day. Now, what is an internal check? An internal check is concerned with the maintenance of accounting records. So when we talk of an internal check, we are just saying that the accounting records should be well maintained. But how do we have to ensure that they are being well maintained? We have got what are called internal checks. Internal checks, sometimes known as internal controls, ensure that transactions to be recorded and processed have been authorized, that they are all included, and that they are correctly recorded and accurately processed. So when you talk of an internal control system, we'll be saying that the objectives, it is a system. Okay, sorry, let me just write here: system that makes sure management objectives. My board here is having a problem. Management objectives are met. Okay, this system ensures that the management's objectives are met well in time and at within the stipulated quality. Okay, thus an internal control system. All right. For example, let's say the objective of managers is to have a good wage system. Okay, a wages system. Okay, the idea of managers would be to have employees paid their dues in time, in right quantities, right amounts. Okay, employees are paid their dues in time and in right amounts. Okay, all deductions to authorities. Okay, to authorities. For example, e.g., social security, deductions. The NASA. In Zimbabwe we call these the NASA deductions, or to Zimra, the pay as you earn tax has been accurately deducted and sent to Zimra. That's an example of an internal check. Okay, that's the example of an internal check. There should be a system that oversees that such processes are being done properly and enough authorization has been given by those in power. All right. So an internal check is also called an internal control system. All right, which will ensure that the transactions to be recorded and processed have been authorized, that they are all included, and that they are correctly recorded and accurately processed. All right, so this is a system which will oversee that everything is going according to plan. Now, there are various types of internal checks. All right, in our previous studies so far, we have touched on these, the first two. If you still remember, we talked about the trial balance. All right, where we say that the trial balance usually helps us to determine if the debit and the credit agree. Okay, if they don't agree, then there could be some error somewhere. All right, so it tells us if the information in our general ledger is actually correct in terms of the double entry bookkeeping system. All right, remember, I have always indicated in my lectures that the double entry bookkeeping system is going to be our patron in all these studies. It's going to be always there. It is going to hound us. We have to be comfortable with the issue to do with double entry bookkeeping, where we say that the debit should always equal to the credit. That's the principle when you talk of double entry. Okay, should equal to the credit. The debit side should equal the credit side. Every transaction has got two effects. It will affect the debit as well as the credit. Okay? Every transaction, whether you go to buy a loaf of bread, you are going to have, by the end of the day, a situation where something is going to be debited, something is going to be credited. All right? Now, the trial balance being a list of balances from the general ledger, what it means is that if it does not agree, then something could be wrong in the way the transactions were recorded. All right, but we also highlighted that there were also situations where even if the trial balance is balancing, there could be some error somewhere, because a trial balance cannot detect certain errors. For example, the error of complete omission. This side is a problem. There is an error of omission. Error of commission, error of principal. We talked of complete reversal. Please revise. Replay the videos which were sent to you on these errors, which will not affect the trial balance. Which will not cause the trial balance not to balance. All right, please just revise them. Okay, there's also an error of original entry. We talked about these ones, and just have to. So these errors, when they occur, they are not going to be detected by the trial balance. The trial balance will continue to agree, but in error. But on the same note, we said that it is better to do the trial balance first, because it's so embarrassing to just proceed preparing your accounts when your trial balance is not balancing at all. That one, you will be just giving the auditors a walk through the park when they will be auditing you. So please just make sure that your trial balance balances, and even if it is in error, it's better. Okay, that one is better than just continue with your ramble when you know that things are not just bad at par. Things will be just bad at par. All right, let's go on. So there's also an issue of bank reconciliations. They're also part of the internal control system, because when you do the bank reconciliation, we'll be knowing which transactions are still outstanding, which checks are still not cleared by the bank, and so forth. That's another internal control mechanism. Then control account reconciliation. This is the business of the day-to-day. There's also issues to do with segregation of duties, which is another form of internal checks. For example, the person preparing a check should not be the person who signs it. Alright, so there should be some division of responsibilities, okay, where we say that one person should be doing this and the other should be doing that. Okay, then lastly, authorization. There should be some people who are going to authorize particular transactions. We do not want a situation where there are no authorizers. Everything is being done by one person and so forth. That one is actually not good, or everyone is authorized to do whatever purchase, everyone is authorized to start a transaction. No, there should be some different people who have to be consulted first, and then those ones who are going to implement. So there should be people who are at least of authority above, and then other people who will be now sent to implement the transaction. Now, control accounts. A control account is an account in the general ledger in which a record is kept of the total value of a number of similar but individual items. Alright, so a control account is in the general ledger. General ledger. This is where the disaster is. Now, let me just take you back to the books of original entry. Okay, books of prime entry. Prime entry. Alright? These books, ladies and gentlemen, we have to know them. Okay, there is what is called sales day book. Sales day book. There is purchases day book. There is a cash book. There is a pet cash book. Okay? Now, these books, they feed the general ledger. Okay? Whatever information they have, it is then taken to the general ledger. But one thing you have to know is that the general ledger takes totals. Okay? Totals. The totals, they go to the general ledger. Okay? So the general ledger takes totals. Totals. Alright? But we have got what are called memoranda books. Memoranda books or records. Oh my gosh. Which one now? Where am I? Okay. Memoranda books. Okay, we have got on memoranda books. We have got what is called the receivables ledger. Receivables ledger. Payables ledger. Payables ledger is also called the purchases ledger. Okay, it is a record or a list of credit customers. Okay, it is a list of credit customers. Okay, there is credit suppliers, and then the receivables ledger is a list of a list or a record of credit customers. All right. Now, these books, the memoranda books, they also take their information from the books of prime entry. But what type of information do they take? these guys, they also take from these two. They take from, for example, the payables ledger take its information from the purchases. Okay, it takes its information from the purchases daybook, while the receivables ledger takes its information from the sales daybook. It takes from the sales daybook, but the payables ledger takes its information from the purchases daybook. But what type of information does it take? It takes information per customer. Per customer. For the receivables ledger, they take information per customer. Okay, per customer. But when the general ledger takes information from the same sales daybook, it takes the total of all the credit customers. It takes the total of all the credit customers. But the receivables ledger takes information line by line. So that's per customer, per customer, per customer, per customer. Are we together? Why is it so? Because the receivables ledger is like, in the receivable ledger, we'll be having portions or pages per each customer. Each customer has got an account page for its own, another customer as well, same like that, and so on. Okay, so that's what happens here. These ledgers, the general ledger and these memoranda books, the general ledger and the receivables and payables ledger, they don't share, they don't interact. No interaction. No interaction. That's the control that is there. They don't share data directly. No interaction. No interaction at all. Even if they've got almost similar names, they all contain ledger, they don't share any interaction. They don't interact directly or even indirectly. They do not interact. But by the end of the day, they should report the same thing. Okay? By the end of the day, they should report the same thing. This is the concept of control account. So in the general ledger, like I said, control account is an account in the general ledger in which a record is kept of the total value of a number of similar but individual items. We are saying that, for example, in the general ledger, there is what is called receivables control account. Receivables control account. This receivables is a total of all the receivables the company have. The general ledger will be reporting the receivables in total. This is what is meant by this statement. The general ledger will be reporting the receivables in their totality. Okay? In their totality. As a total figure. But when you want to know more about that total, you then have to consult the receivables ledger. This will give you information about Mr. So-and-so is owing us 200,000, Mr. So-and-so is owing us this much, Miss So-and-so is owing us this much. So the receivables ledger or payables ledger, these are also called lists of balances. They're also called lists of balances. So when you see a question that talks about list of balances, the list of balances was this much, list of balances was this much, you then have to know that they are referring to the memoranda books, to the receivables ledger or the payables ledger. You then have to, if you know that principle, if you know that position, then you're home and dry. You're not going to be vexed by any exam. Are we together? So the word control account is usually prevalent in the context of receivables and payables, although It can be used for other items, like for example, wages control account, salaries control account, etc. Okay, so do not be vexed, do not be worried when you face another term like wages control account and you ask yourself, where is this coming from? The examiner will be just telling you that we are talking of the general ledger body, we are talking of the general ledger issues. Okay, I'm sure there we are done. Let's move on. All right, so typical entries in control accounts. So here we are having two situations for the purchase ledger and the sales ledger there. All right, they are just examples there, and you can see that in the case of receivables ledger control account, we are going to have a double entry situation. Okay, these are double entries. There is a credit, there's a debit and credit, debit, credit. Why? Because in the general ledger, that's where the double entry should be complete. This is why I say that by the end of the day, accountants come, they have to draw up a trial balance to ensure that the debit and the credit balances. Okay, so for example, this sales ledger, let's look at the sales ledger. The opening balance of the receivable control account. Remember, the receivable control account is also called the sales ledger control account. Receivables, they are credit sales, so this is why it is called sales ledger control account. Excuse me. Okay, then purchases ledger is also called payables ledger control account. Why? Because payables are credit purchases. Credit purchases. Okay, let us focus on the receivables ledger control account. You can see that the opening debit balance brought forward was 7,120. Okay, but one thing I want you to notice is that the PL's acronym, I always advocate for that these PL's is actually a good tool for us, ladies and gentlemen, throughout our Acca studies. Okay, the PL's. The P stands for purchases, E expenses, A assets, R revenue. Revenue is almost like sales. Okay, revenue. Okay, you may also consider it as retained earnings. Okay, retained earnings or retained profits, retained earnings. Then L is liabilities. S, you can call it sales. Okay, sales or share capital. Okay, whatever, all these are increased by crediting. This is why I put the CR there, because they are increased by crediting. Just have to credit them. So everything from RLS, just have to credit it. But when you talk of purchases, these ones are increased by debiting. Okay, so receivables are assets. Receivables are assets. This is why they are having a balance brought forward debit. A balance brought forward debit here. It's on the debit side. Okay, then when we increase, when we sell more goods on credit, like in this case, they sold goods. This is SDB, this is a sales day book. SDB is sales day book. Sales day book reference. Okay, and the sales day book was saying that they sold goods on credit for 52,500. So our receivables were increasing. This is why we are debiting them. We are increasing the receivables. Increasing the receivables. Are we together? Then, when we receive cash, when we receive cash from the credit customers, we reduce the receivables. Okay, we reduce the receivables because people have paid. So when they pay, we reduce. But where do we record that in the books of accounts? We record that one in the credit part to reduce the debits here. To reduce the debits, you have to reduce them by crediting those debits. We credit them. By crediting, we'll be reducing. This is why you see the cash received from customers here as on the credit side, because we are reducing the receivable. We are reducing the asset, we are reducing the receivable. Okay. Then there is discounts allowed. Discounts allowed, they also reduce the amount we were expecting to receive from customers. So this is here. That's why they put it there. Then there is returns inwards from customers. If customers have returned goods, that's again a reduction to our receivable. This is why it is here. Then irrecoverable debts. Some customers cannot be recovered at all, though, so they have reduced again our receivable. Then there is this guy here, the dishonored bill. Somebody came to us and gave us a check knowing that in his bank account there was nothing. Okay. All right. So what happens is we have to put him on the debit side, but somebody is saying, hey, but there was nothing we've received, so why do we have to put him there? The reason why we are putting him there is because we want him to pay, so we are recognizing this. Okay, whatever payment he had made, if the payment had been successful, it should have been recorded on the credit to show that there is a reduction. But in this case, it is an increase to the receivable, right? Because this guy has to pay. All right, the owner of that check should be conducted and pay our money. So we are going to put him on the debit side. It's still a receivable, this one, and it has to be cleared. Now, after doing all this, you then have to add up, and we indicated that the side with a large amount should have its balances here. So in this case, the debit side is actually the side with the larger amount. So we are going to have our balancing figure, that is the balance CD of 5,800 on the credit side, and this is going to be transferred here as the debit balance, as a balance brought forward. So you use the same principle to understand the purchases ledger part of it. All right, so you can just replay what I've explained on the sales ledger for you to understand what is going on the purchases ledger control account. Remember, the purchases ledger is for credit purchases, it's for payables. All right. So why do we need control accounts? Control accounts have various uses. They check accuracy of entries made in the personal accounts. And personal accounts, these ones are also called memoranda. Memoranda accounts. Okay, and these are those are receivables ledger or purchases payables ledger, or purchases ledger rather, no problem, payables ledger. Okay, so they check accuracy of entries made in the personal accounts to see if those entries were actually okay. Then they assist in the location of errors. Yes, because if they fail to agree, then by the end of the day, we have to investigate and see where the error was coming from. Okay, they act as internal check where there is separation of bookkeeping duties. Sometimes you might be having a receivables control account and so forth, but because one person is doing everything, there is a likely possibility that fraud will be perpetrated even if you observe the control accounts issues. Okay. A balance can be extracted quickly for producing a trial balance or statement of financial position. So if we do control accounts again, it means that our record keeping is going to be as efficient as possible. Sorry. Reasons behind control account and personal ledger balance differences. As I have indicated that by the end of the day, the general ledger, what it purports or what it refers to, should actually tally with what is being referred to by the memoranda accounts. But you may discover that these often report different things, and these are the reasons. An incorrect amount may be posted to the control account because of a miscast of the total in the book of prime entry. Okay, when you made some errors in adding up. Alright. The general ledger debit and credit posting will then balance, but the control account balance will not agree with the sum of individual balance started from the memoranda account receivables, memoranda, receivables ledger or payables ledger. A journal entry must then be made in the general ledger to correct the control account and the corresponding sales or expense account. B. A transposition error may occur in posting an individual's balance from the book of prime entry to the memoranda ledger. For example, the sale of N Horrocks of $250 might be posted to his account as 520. This means that the sum of balances extracted from the memoranda ledger must be corrected. No accounting entry would be required to do this except to alter the figure in N Horrocks' account. So here they're just saying that, remember, the sales day book. The sales day book is used to feed the general ledger, as well as the sales ledger. Okay, general ledger, and we say that here we add all the transactions, the credit transaction involving our credit customers. Okay, we add the total. So here we take the total of the sales day book that day, the totals. We add up, we cast everything. Then here, when we extract data from the sales day book to the sales ledger, we then take line by line, or customer by customer. All right. So, as indicated in B there, we might do the casting to the general ledger and take the correct total. But when we were now extracting information to the sales ledger, when we're extracting a particular customer's transaction, we then interpose the figures. Okay, we then interpose the figures. So when then we calculate the totals of the list of balances, we will discover that there was actually an error because they will not balance. These two, the GL and the SL, the sales ledger balance and the general ledger balance for receivables, should agree, but in this case they will not agree. Okay, so that's another reason why we need a control account to determine, to help us know where the error was coming from. A transaction may be recorded in the control account and not in the memoranda ledger, or vice versa. This requires an entry in the ledger that has been missed out, which means a double posting if the control account is to be corrected, and a single posting if it is the individual's balance in the memoranda ledger that is at fault. The sum of balances extracted from the memoranda ledger may be incorrectly extracted or miscast. This would involve simply correcting the total of the balances. You need also to understand the impact of each error. Some errors do not affect the general ledger, others simply affect the memoranda records. You just have to understand what is going on. But what is very important is that the source documents are the books of prime entry. Do not take information from the receivable ledger to correct the general ledger. That one is wrong. Okay, everything should be referenced to the book of original entry. All right, because these books, they do not on their own interact. All right, so it is better to investigate why there is a difference by looking back to the source documents. Okay, now I think we need to do the real deal. Okay, all right. Control account reconciliations. As aforementioned, the receivables and payables control accounts should always agree with the sum of the balances on the receivables and payables ledgers respectively. If they don't, then an error must have been made and needs to be corrected. Correcting control account and ledger errors is a common exam requirement. Please be warned. This is a very common exam requirement. This is why at this stage I don't want you just to just say we've covered control accounts, let us go to the next, because you're only left with one or two topics. Please, I just want you to breathe, to relax and understand, because this is where most of us get disappointed, because this is a very tricky accounting issue. Okay, it's a very tricky accounting issue. If control accounts, if the receivables and payables control accounts do not agree with the balances or with the list of balances, these guys here, these balances, I've already told you that they are also called list of balances. Okay, so if the GL balance does not agree with the list of balances, then there is a problem, and there is going to be a problem if that is the situation. The accountant has to do more work. If he used to knock off at 5 o'clock every day, on this particular day he might knock off at 2 o'clock in the morning. This is where the job is. Okay, let us do this problem together. Okay, let us do this problem together. So just read it. Okay, I'm giving you 5 minutes. I'm giving you 5 minutes. Just do it on your own. Okay. A receivables control account balance is 3,825. The three receivable account balances in the receivables ledger are as follows. Okay. Let me explain one thing here before we attempt this question. Okay, please take note. Receivables ledger. Okay, receivables ledger and receivables control account. They are going to come, these terms. Okay, they are going to come. I have indicated already. You just have to know that the receivables ledger is simply a memoranda record, okay, or a list of balances for receivables. The receivables control account, this is the balance that is found on the general ledger. This is the balance which is part of double entry. This is part of the double entry bookkeeping system. But the receivables ledger on their own, they are not part of the double entry bookkeeping system. Okay? They're not part of it. They are memoranda accounts. They're not part of the double entry bookkeeping system. I just wanted to highlight it here so that we move on the same page. Okay? Some are even lost by this you know, they're already lost. Don't worry, I'm here for you. Okay, don't get lost. Okay, so let's go together. A receivables control account balance is 3,825. This is actually in the GL. Okay, this is the general ledger balance. Right, this one is a general ledger balance. A receivables control account balance. That's a general ledger balance. The three receivables account balances in the receivables ledger, this is now a memoranda, are as follows. We've got a customer name and amount owing. The customer A limited, this one, B limited, this one, C limited, that one. And if you add up, what is the total there? You just have to be very innovative and try to add up things to see if the total is actually what is there on the ground. Okay, that's 3952, which is this one. Okay, then yeah, it's nice to put underlines there. It's okay. Something must have gone wrong because the control account balance does not agree with the total of the individual balance. Okay, you can see that they are not agreeing, isn't it? The GL is talking about this figure, okay, but the receivables ledger is talking about this figure. All right, so upon investigation of the entries, the following were identified. An invoice for 425 in the day book was posted to C Limited account as 452. Does this error affect the GL? This is where our problem is. Obviously, this error is not going to affect the general ledger because it was an error which occurred when the accountant was extracting information from the source record, the source day book, to the to the receivables ledger, or to a memoranda account, or to the list of balances. So this error is to be corrected with the list of balances only. It does not affect the general ledger. Am I talking to somebody? Am I talking to somebody? Good. So what happens is we have to correct the list of balances. List of balances. Balance brought forward. What is the balance brought forward for list of balances? The list of balances. The balance brought forward. This is our balance. Balance PD. Okay, that's 3. This whiteboard of mine. Okay, let me just try. Sorry. Just try to squeeze things here, guys. I'm sorry. Okay, list of balances. Balance brought forward was how much? 3952. Okay, this one, 3952. And then we are told item 1 here that an invoice for 425 in the day book was posted to C Limited account as 452. All right, so there was actually a transposition error, and the invoice was overcharged. Okay, it was overcharged when it was being extracted to the memoranda account. But remember, this does not affect the general ledger anyway. Okay, so we just have to correct the list of balances, and we say number one, 452 minus 425, we get 27, bucks. All right, so this one has to be, has to be deducted. So that's 27 here, should be put in brackets. All right, then it has to be reduced. Okay, then we are told number two, an invoice for 500 in the daybook was posted as $200 to BC account. Excuse me. Okay, so the invoice for $500 in the daybook was posted as 200. Is this an error of transposition, or it is almost an error of commission? It's almost an error of commission here, or posting error. Okay, so there was an under invoicing issue here. So we do the same thing, 500 minus 200. This one again does not affect the GL. Okay, it's 300, but it is something to do with posting to ledger, to memoranda accounts. So this 300 has to be added because we had undervalued this invoice, so we have to add it. Okay, all right, what about item 3? The sales daybook was undercast by $400. Now, when the sales daybook was undercast, this is an impact on the general ledger, because we said that the general ledger takes the totals. The general ledger takes the totals. So this one is a correction to the general ledger. So we just have to hang it on so far. So that's let us add up this one: 3952 plus 27. Minus 27 plus 300, and we must get this amount. Okay, so this is the corrected list, corrected balance for the list, or corrected list balance. Okay, the corrected list is this one. Okay, that's the value we need. But we then have to see if we are going to come up with a control account balance that is of the same value. So we say control account balance BD is given. The balance BD was how much? We are told it was this one, 3825. 382. Oh, my pen. I've exceeded the boundary. Okay. Sorry, my pen, what are you doing now? Oh my god. Let me just try to change the pen color. Maybe to respect that. What's going on? Okay. Control account balance BD 3825. Okay, then there is this error which has got an impact on the GL. So the undercast error 400. So if we add them up, we must arrive at the same figure. In this case, we have done our control account reconciliation. Are we together, ladies and gentlemen? Okay. Let me see if there is still another example we can talk about. Because I don't want to hear you guys crying all the time. Okay, so let us do this example together, ladies and gentlemen. A business, okay? A business has a memorandum receivables ledger, okay? A business has a memorandum receivables ledger and a receivables control account, which is part of the double entry. The balance on the receivables control is 15,091. However, the list of receivables ledger balances totals 15,300. The following errors are discovered. A receivable paid $10 in cash. This has been correctly recorded in the receivables ledger, but no entries have been made in the receivables control account. So you can see that this affects the GL. Okay, one of the receivables had a credit balance of 60. However, this has been included as a debit balance in the receivables ledger total. Does this have any effect on the GL? No, this one is a sales ledger item. It's something to do with the receivables ledger or the sales ledger balances, okay, or the list of balances. Returns inwards of $35 have been recorded in the receivables ledger but not in the receivables control account GL. Okay, one page of the sales daybook has been undercast by $100, and that's a GL because the sales daybook, if the sales daybook has been undercast, it means that when they were extracting the totals, they missed or they did not consider the 100. So that's a GL. When a sales invoice for $95 was entered in the receivables ledger, the figures were transposed as shown as 59. So when when sales invoice for 95 was entered in the receivables ledger, the figures. So you can see that this one is actually a sales ledger item. It's something to do with the sales ledger. Then, an error has been made in totaling the list of receivables ledger balances, which has been overcast by $90. An error has been made in totaling the list of receivables ledger balances, which has been overcast by 90. Yes, here they are talking of, because by the end of the day, the list of balances has to be totaled, but that has nothing to do with the sales table totaling. So this one is a sales ledger issue. It's a receivables ledger or sales ledger item or error. So once you know this, you can now simply do your control account reconciliation. Okay, so what then do we have to do? All right, let's find a clear space. Let's hope there everything we need is going to be super there, but I think the space is very small. We can first deal with the sales ledger first. Sales ledger items. I think by doing so, we'll be giving justice to ourselves. Now, the receivables ledger. Receivable ledger. Alright. Balance PD. The receivables ledger or list of balances. List of balances. Okay. ledger or list of balances. Okay, what was the balance brought forward for this one? The balance on the receivables control this one. However, the list of balances, the list of receivables ledger balances totals 15,320. So 15,320. Okay, let's put a dollar sign there. Now we've got this balance brought forward. We put it there. Then let us now adjust that balance with the errors which have been identified. Now, one of the we just go straight to the portions we indicated. This is the sales ledger, this is the general ledger item, and so on. So let us go to the sales ledger issues. One of the receivables had a credit balance of 60. Right? Had a credit balance of 60. However, this has been included as a debit balance in the receivables ledger total. So you need to ask yourself what is going on, okay? Because if a receivable had a negative balance, had a credit balance, but we recorded it as a debit balance, then there could be some double impact there. So this issue, the credit balance, okay, 60 by 2, because we have to correct that, okay, to reverse the impact. So we just have to deduct it, okay. Then what else? I think the other item is when a sales invoice for 95 was entered in the receivables ledger, the figures were transposed and shown as 59. So there was some transposition error here, but the impact was to reduce the error, reduced the receivable, okay, the error reduced the invoice. So we have to ensure that the receivable is brought to its actual figure of 95. So the difference is how much? The transposition error, how much was this? 95 minus 59, and we can see that there was a 36 which should be added. It should be added to ensure that we recover that money. And then there was also an error when totaling the list of balances, the list of receivables ledger balances, which has been overcast by $90. Okay, when they were totaling the list of receivables ledger balances, they overcast by 90. An error has been made totaling the list of receivables ledger balances, which has been overcast by 90. So this overcast has to be dealt with. So overcast. We have to ensure that the overcast is deducted. Okay, we have to ensure that the overcast has been deducted. So if we do our calculation, where is my calculator? Just give me a minute, please. I'm just trying to locate this calculator of mine. Okay, we're saying 15,320 minus 120 plus 36 minus 90. I'm getting 15,146. 15,146. I'm sure you're also getting the same figure. All right. So that's the adjusted receivables ledger total, or the list of balances. The adjusted list of balances. This one, list of balances. The balance of the list of balances. Okay. Okay. Adjusted. Okay. Now let's do the control account, the receivables control account, to see if it is going to give us the same figure there. Because I say that the receivables was what we have calculated is the balance according to, this is the balance according to the sales ledger. We now want to find the balance according to the general ledger. Okay, we now want to find the balance according to the general ledger. This is what we are going to do. So the general ledger has got to receivables control account. And here we are doing the double entry. Why? Because that's where the double entry is. Okay, this is where the double entry is. It is not found in the list of balances. The double entry is found in the general ledger. Okay, so we are now going ahead with our problem, but we need first the balance brought forward. And remember, receivables are assets. Assets have got debit balance. So obviously the balance brought forward, receivables balance BD from the question should be on the debit side, obviously. The balance on the receivables control is 15,091. 15,091. Okay, now let us now adjust with the items, with the issues we were told by the examiner. Okay, from the errors, the receivable paid $10 in cash. This has been correctly recorded in this receivables ledger, but no entries have been made in the receivables control account. So if a receivable has paid, what is the double entry there? Obvious, okay, this pen of mine. The double entry should be, we debit the cash and credit the receivable. Okay, debit cash, credit receivable. Why are we crediting the receivable? Because this guy had paid. They have paid, so we want to reduce their receivable. So that's $10 should be recorded. Okay, $10 should be recorded. All right, so cash $10. All right. We are told, so we are done with this part. Okay, we are done with this part. Then let us go to C. There is a geo item here. C. Returns in worth of $35 have been recorded in the receivables ledger, but not in the receivables control account. Okay, returns in words of $35 have been recorded in the receivables ledger, but not in the receivables control account. Returns in words, they reduce our receivables, so we also have to record them here. Returns in words 35. Okay. We used to have other items there. One page of the sales table, has been undercast by $100. So this one, there was an undercast, so we have to ensure that we come to the right balance. We have to add it to the receivable balance brought forward there, and after doing this, we then have to total. This is balancing the accounts, if you still remember. Okay, so if you add up, you must arrive at 15,191. 15,191. Why is 15,191 being put on both sides? Because we believe that the credit and the debit should balance. Right? Should balance. But if you do the mathematics, you will see that on the credit side, we only have got 10 and 35. And for us to reach 15,191, we have to put another entry here, the balance CD, which is the balancing figure. And this balancing figure should be, how do we find this balancing figure? You say on your calculator, 15,191 minus 10 minus 35. Sorry, minus 35. And you must arrive at the balancing figure. Alright, let me just use my calculator here. 15,191 minus 10 minus 35. I get 15,146. Excuse me. Okay, so you can see that my balance brought forward for the receivable is 15,146, and this balance should tally with the balance I found here, which is this one. Then I can safely say that I've reconciled my control account. Okay, actually you've been helped here, and you're now going to find it easier to do your assignments, and please just do the assignments. Okay, please just do the assignments. Now, just as a summary, okay, just as a summary, an internal check, please, you just have to understand this. An internal check is concerned with the maintenance of accounting records. Internal checks are sometimes called internal controls. They ensure that transactions to be recorded and processed have been authorized, that they are all included, and that they are correctly recorded and accurately processed. A control account is an account in the general ledger in which a record is kept of the total value of a number of similar but individual items. Control accounts have various uses. They check for accuracy of entries made in the personal accounts. They assist in the location of errors. They are an internal check where there is separation of bookkeeping duties. A balance can be extracted quickly for producing a trial balance or a statement of financial position. For various reasons, the balance on the control account may not agree with the sum of the individual receivables or payables balances extracted from the receivables or payables ledger. Lastly, at the end of an accounting period, accountants will perform certain regular routines in preparation for putting together the financial statements of the entity. For internal purposes, the accounts may be produced on a monthly basis, whereas full accounts will typically be produced at the end of the financial year. Okay, so ladies and gentlemen, we can safely do the assignments. All right, I'll take you through. I'll just pick any 3 questions for your practice. Okay, but you are going to do all the questions. So in these assignments, I've put a lot of questions. Some of them might be related to control accounts, some might not be. Because we are almost at the end of the syllabus, I expect you to be also showing me that you still have what we've already covered in your heads. Otherwise, if you are still finding some of these questions is new to you, it means you have forgotten what we have already covered. All right? Good. Now, we're having this one question number 1, which is actually a very interesting question, and I hope to you it's going to be very easy. You can just pause the video, you do it on your own. The total columns in a purchase daybook are as follows. We know the purchase daybook. Purchase daybook records purchases on credit. So we've got names of suppliers, the net amount, the sales tax amount, the gross amount of those purchases, including the details. To where are these figures posted in the ledgers? Ladies and gentlemen, whenever you are asked of things to do with the double entry, make sure the PL's acronym, the PL's acronym is your passport. You just have to have the PL's acronym by your side. That's a very faithful partner to walk around with. Just work, just walk, just do everything accounting with the PL's acronym. Okay? We know that P is for purchases, E expenses, A assets, R revenue, L liabilities, S share capital. You are home and dry if you know your PLs. Now, in this case, we know that the purchases daybook is for purchases actually on credit. Okay, so whenever you buy goods, let us ignore the tax component for now. Whenever you buy goods on credit, you debit purchases, okay, and credit supplier. Let us just forget about the tax. But now, when the tax element is something to talk about, obviously the tax element is considered as part of the purchases. So obviously the direction where the purchases is should also be the direction of the tax, sales tax, if tax is involved. So obviously the purchases will be net of tax, without tax, and then we've got the sales tax amount reported separately, because that's what is required on the ground. The tax authorities, they want their tax to be presented separately from other transactions or from the relevant transactions. So the purchases there, we're going to debit purchases and debit the sales tax, okay? And then we have to credit the payables or credit the supplier. Okay, so you can see that the answer is very clear there. The answer is very clear. I am not going to pinpoint which is the answer, but somebody who has been listening, somebody, if you have been listening, somebody saying amen, amen, show us the answer. All right, the answer is D. Okay, for number 1, the answer is D. Very, 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 very simple. Okay, so for others, they're going to do it alone. Then there is an issue. Okay, there is an issue here where I thought to myself, hey, what a hectic situation we are having here. All right, let's talk about question number 3, because somebody was saying, hey, tutor, it seems question number 3 is something that maybe you were drunk, tutor, when you were giving us this question. I wasn't drunk, ladies and gentlemen. I am not drunk at work. I'm not drunk on duty. I'm always sober. Okay, I'm always sober. Now, this question is saying a debit balance of $100 on an individual's ledger account in the payables ledger has been listed as a credit balance when adding up the list of balances. A debit balance of $100 on an individual's ledger account in the payables ledger has been listed as a credit balance when adding up the list of balances. To correct the reconciliation of the control account with the list of balances, what happens? So, what will happen when we want to correct this issue? Okay, we can just attack option by option. Do we have to credit 200 to the control account? Does this issue affect this? What is the nature of the issue? Obviously, this is a payables, a purchases ledger issue, not GL. Not GL. The general ledger is not affected. So if the general ledger is not affected, the control account is not affected. So our answer should be between C and D. That's where our answer is. These ones are out. In an exam situation, you just have to be guided by the principle. You just have to be guided by the principle. Obviously, C and D, that's where our answer should be. But on the list of balances, remember, we have determined that this is a purchase ledger issue, which is a list of balance issue. So, do we have to decrease the list of balances by 100, or do we have to decrease the list of balances by 200? A debit balance of 100 on an individual's ledger account is in the payables ledger has been listed as a credit balance when adding up the list of balance. Obviously, there should be a decrease by 200. So, the answer there is C. Very simple, isn't it? I don't want you guys to cry and cry over these issues. Okay, you mustn't cry. Alright, I think we can just do the last one. Let's go to question number 7. This should be the last one, and we call it a day. Okay, we call it a day. The total of the balances in the accounts receivables ledger is $800 more than the debit balance on its receivables control account. The total of the balances in the accounts receivables ledger is $800 more than the debit balance on its receivables control account. Which one of the following errors could by itself account for the discrepancy? The sales daybook has been undercast by $800. Yes, if the sales daybook has been undercast, obviously there's going to be some error in the general ledger. Okay, general ledger error. Obviously, it might explain this. Okay, it might explain this. But let us see others. Settlement discounts totaling 800 have been omitted from the general ledger. If we have omitted, let's say, the discounts, do you think there's going to be some disparities where we have, because we are talking of receivables, okay? So this should be discounts allowed. We are talking about it. We are not talking of discounts received. Okay, so we are saying the discounts which we have allowed to our customers, we did not, because discounts allowed are expenses. Okay, they are expenses. Discounts allowed, expenses. Expenses are increased by debiting. Remember the PO's acronym. The PO's acronym. So we did not debit them. Okay. Okay. Now, being an expense. Okay. Being an expense, because we are saying that on our PO's acronym, our PO's acronym, we are going to have these first three guys being debited and these ones being credited. Alright, discount allowed is an expense to the business because we are allowing our customers to just take goods at a reduced value. Alright, so the assumption which excuse me, which a clever student would do or would have is that the settlement discounts which are being spoken about by the examiner are discount allowed. Okay, these are discounts allowed. However, from the type of question here, we only want one possible cause for the discrepancy. All right, and certain assumptions could be very dangerous, while others could be very, very helpful. All right, assume this is settlement discount for is discount allowed. Then we can see that if we do not debit the 800 as part of the expense, then obviously we are going to have the same situation as on A. Okay, we are going to have a disparity of $800 where we are saying that the debit is undercast by $800 or the debit is in shortfall by $800. Okay, but from the look of things, like I said, you can see that A is a bit safer in the sense that it actually lead us to the error right away. If the sales depot is undercast by $800, then obviously the general ledger is also going to be undercast by $800, which is actually the main error or a clear error to explain the discrepancy. Okay, so it is a bit safer to then assume that these discounts allowed, which were being spoken about, could be discounts received. Okay, the examiner is not clear there, and if the examiner is not clear about something else, then just go for a clear answer, and you are home and dry there. All right. So because here they only want one best answer, they want one very clear explanation for the discrepancy. All right. So at this juncture, it is actually safer to, because if it was actually a discount received which has not been recorded, a discount received is a credit entry. So if a credit entry has not been recorded, then we are not going to have this disparity. In this case, when a settlement discount is not recorded, then that settlement discount should be having a debit impact, and a settlement discount with a debit impact is a discount allowed. But we are saying that that one is actually based on assumptions. Okay, the examiner has to be actually clear, and in an actual exam, that clarity is going to be given. They're not just going to just give you hidden issues like that. Okay, but for practice sake, I would also want a student who just say, hey man, can you please come up, can you just be specific here, like some of you like what some of you do. You actually contact me anytime. You just have to continue doing that, so that no one should be left behind. We just have to walk on the same terrain. Okay, what about C? What is wrong with C? One receivables ledger account with a credit balance of 800 has been treated as a debit balance. So if we have treated a receivable with a balance of 800 credit and we have treated them as a debit balance, then the disparity is going to be marginal. I mean massive. it's going to be very, very large. Okay, this is going to be like 800 by 2, which is almost about 1600 disparity. And you can see that this is far away from the 800 problem which we are having at hand. So C is actually far-fetched. Then D, the cash receipts book has been undercast by $800. The cash receipt book, the idea here on part D is that we are being tested on our appreciation of the double entry bookkeeping as well. The cash receipts book has been undercast by $800, which means that when we were adding up the cash receipt book, we then made an error. We undercast by $800. So the impact is that let's say a receivable is paid money. The entry should be debit cash and credit the receivable. Okay, so let's say the cash was under by $800 as in the question. Okay, it also means that the amount to be credited is also lower by $800. Are we together? So the receivables control account is also going to have a credit entry, or the credit side is going to be lower by $800. But you can see that the question is saying the total of the balances in the commerce receivable ledger is $800 more than the debit balance on its receivable. Okay, so we can see that in this case, the commerce receivables ledger is $800 more than the debit balance on its receivables control account. We can see that in this case, it is the debit side of the receivables control account that is in shortfall. But if we follow these dictates, the dictates of D, in this case, it will mean that the credit side rather is the one that has got a shortfall of $800, which is actually wrong. So option D is only going to lead us to a situation where we are having a credit side, the credit side which is in shortfall. Okay, so like I have said, ladies and gentlemen, the best option is A. Okay, A is the answer there. But everything is going to be smooth with practice and everything, and you just have to make sure that you conduct your tutor all the time when you are stuck, and we deliberate. It is better for us to spend more time deliberating on things than to wait for surprises on examination day. Until we meet again, I think we can call this a good day. Okay, but ladies and gentlemen, like I've always indicated to you, I'm always available for you. I'm always available, and when you face a challenge, please let's talk. Okay, let us always talk. All right, let us always engage. Okay, this is the reason why you've had me to be your tutor, your mentor. Nobody is perfect. Nobody knows everything. I also learn from you, and you also learn from me. So it's an issue of information sharing. Okay, and we improve by the end of the day. Okay, I thank everyone else out there who have also contributed to the success of this lecture, and you guys, my loyal students, may the good Lord bless you. Until we meet on the next chapter, may the good and wonderful Lord's countenance shine upon you. I am signing out.